The Federal Reserve on Wednesday enacted its second consecutive 0.75 percentage point interest rate increase as it seeks to tamp down runaway inflation without creating a taking the benchmark overnight borrowing rate up to a range of 2.25% minus 2.5%. The moves in June and July represent the most stringent consecutive action since the Fed began using the overnight funds rate as the principal tool of monetary policy in the early 1990s. While the Fed funds rate most directly impacts what banks charge each other for short-term loans, it feeds into a multitude of consumer products such as adjustable mortgages, auto loans and credit cards. The increase takes the funds rate to its highest level since December. Rkets largely expected the move after Fed officials telegraphed the increase in a series of statements since the June meeting. Stocks hit their highs after Fed Chair Jerome Powell left the door open about its next move at the September meeting, saying it would depend on the data. Central bankers have emphasized the importance of bringing down inflation even if it means slowing the economy. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the. In its post-meeting statement, the rate-setting Federal Open Market Committee cautioned that recent indicators of spending and production have softened. Nonetheless, job gains have been robust in recent months, and the unemployment rate has remained low, the committee added, using language similar to the June statement. Officials again described inflation as elevated and ascribed the situation to supply chain issues and higher prices for food and energy along with broader price pressures. Powell said he does not think the economy is in recession, though growth was negative in the first quarter and was expected to be barely positive in the second quarter. Think about what a recession is. It's a broad-based decline across many industries that's sustained more than a couple of months. This doesn't seem like that now, he said. The real reason is the labor market has been such a strong signal of economic strength that it makes you question the GDP data. The rate hike was approved unanimously. In June, Kansas City Fed President Esther dissented, advocating a slower course with a 0.5 percentage point increase. The increases come in a year that began with rates floating around zero but which has seen a commonly cited inflation measure run at 9.